we will talk about specific ledger accounts. These are capital accounts, drawings, expenses, income, purchases, sales, purchase returns, sales return, stock, cash, credit. These are the ledger accounts, right? These are the ledger accounts, and all these ledger accounts have certain specific entries, right? Maybe opening entries and then further adjustment entries. We will learn how to do these. What is capital account? The amount invested in the business, whether it is in terms of cash or kind. Kind means whenever the owner or anyone who is participating as a partner in the company is bringing certain asset along with the cash or only the asset, that is called kind, by the proprietor or owner of the business is called capital. The capital account will be credited and the cash or assets brought in will be debited. I repeat, the capital account will be credited and the cash or assets brought in will be debited. So cash or bank account debited, assets account debited to capital account. Being business started with cash and assets, right? Next is drawings account. Drawings means whenever the owner of the company is drawing from the company, right? Withdrawal of any amount in cash or kind from the enterprise for personal use, right? Drawings are always for the personal use, then only it will be recorded in this way. Withdrawal, if it is for the office purpose, it will not be recorded. Withdrawal of any amount in cash or kind from the enterprise for personal use by the proprietor is termed as drawings. The drawings account will be debited and the cash or goods withdrawn will be debited. So drawings account debited to cash account to purchases account. See, cash is being reduced because drawings are being done, right? And it will be credited. If the goods are also withdrawn, for example, we have purchased something, certain raw materials, certain things, and if those goods are also withdrawn from the company, the final products of a company that are also withdrawn from the company for the personal use, then purchases accounts are also credited, right? Being cash and goods withdrawn for personal use. Expenses account. Any amount spent in order to purchase or sell goods or services that generates revenue in the business is called expenses. For example, we are paying electricity, we are paying rent of the warehouse, right? These are the basic expenses. We are paying salaries to managers. The cash account will be decreased, right? So whenever asset decreases, it will be credited with the amount paid as expenses. And whenever expenses are being increased, increase of an asset or expense, it will be debited, right? Decrease of an asset, it will be credited. So expenses account will be debited because expenses are being increased. Increased means we are actually paying towards expenses, right? Those expenses are being paid or we are paying something towards expenses, they will be debited. And cash, the asset is being reduced, that will be credited as per the debit credit rule. Being expenses paid in cash or with bank, right? Next is income account. Any monetary benefit arising from the business can be termed as income. The cash account will be increased with the amount received as income. So it will be debited and income account will be credited. So income means incoming of cash. Incoming of cash means increasing of asset. Asset being increased, cash, it can be received in cash or it can be received in bank. So that is why we have written cash / bank account being debited, right? Because we are receiving the income. Now, what can be the income to the company? We are not talking about our income. We are talking about income of the company. Income can be of the company when if we have put certain of our warehouses to rent to someone else, to the third party, the rent received is the income, right? Or any other insurance income received. The incomes of the company are very limited, but yes, cash or bank account debited to income account, right? Next is purchases account. Now this is the important account which we should consider. When goods are purchased in cash or credit, donated, lost or withdrawn. See, sometimes company not only purchase on cash or credit, it also sometimes donate whatever they have produced. Or sometimes the good is lost. How they are lost? Due to fire, due to accidents in go down, right? They needs recording too. or they're withdrawn for personal use. In all these cases, goods are denoted as purchases accounts. So whenever we are purchasing goods, whenever we are purchasing on cash or credit, whenever we are donating them, whenever it's lost due to accidents in the company by nature's action, or whenever they are being withdrawn for personal use, right? They are recorded and denoted as purchases accounts. Now we have four entries related to it because of the four different kind of transactions. First journal entry says goods purchased for cash. Now whenever I'm purchasing goods for cash, cash is being reduced, so it will be credited. Asset being reduced is credited. And I am having purchases, my expenses are increasing. Purchases are my direct expenses of the company, so they are being increasing, so I will debit it. Purchases account debited to cash account with a brief being goods purchased in cash. We have to mention this, being goods purchased in cash. If we do not mention these two words in cash, we cannot specify whether the goods were being purchased on cash or in credit. Of course, we can see with the entry, but these briefings work well, right? Then we have goods donated. Donation account debited to purchases account. Now, whenever we are donating our products, there is like reduce of our goods. Whenever our goods reduced, whenever a stock is reduced, whenever the asset is being reduced, it will be credited. So purchases account is being credited and donation account is being debited, being goods donated. Then goods are withdrawn for personal use. These are already done by us, but we'll still repeat. Drawings account debited to purchases account, right? Again, goods stock is being reduced. Whenever asset is being reduced, it is credited. Then goods lost by fire. Lost by fire account debited to purchases account, right? So these were all the entries related to purchases account. Again, we will write this brief summary. Being goods lost by fire. Then we have sales account when goods are being sold, right? Now, if they are sold on cash, it is cash account or bank account, right? Whether if I'm receiving, so goods are being sold on cash, but the amount is received in our bank account, maybe SBI Bank, whatever ABCD bank, right? Then we will write bank account debited to sales account because our amount is directly being received in bank. But it says that goods are being sold on cash, we will only mention cash debited to sales account, right? Now, when we write this term debtors, whenever we are not having sales on cash, when we say goods are being sold to ABC company, there's nothing mentioned whether any cash is received, whether any check is received, nothing is mentioned, right? It's just say that goods are being sold to ABC company. So ABC company is our debtor, the company who will pay us later, right? So ABC company account debited to sales account. Being goods sold in cash or bank if it is sold on cash or if the check is received, and if it is sold on credit, we will just write being goods sold on credit. We will skip this. So either of this will come, right? We have just clubbed the summary in this. Then purchase return or return outward account. When purchased goods are returned to the supplier, it is denoted as purchase return account or return outward account. Return outward account means whatever is going out. See, suppose we have purchased certain raw materials from supplier A, and I find out of the lot of 10 boxes, 2 boxes of my raw material are not up to the standard, up to the quality. I want to return those 2 boxes back to the supplier A. So I will create purchase return account or return outward account, right? When purchased goods are returned to the supplier. Now, whatever is the supplier's name, that will be debited. Supplier account debited to purchase return or return outward account. See, whenever we were making purchase, it was purchases account debited to cash. Or if I was purchasing on credit, it was for cash. If suppose I purchased goods on credit, it was purchase account to, if my supplier name is supplier A, the entry would be purchases account debited to supplier account. right? Now supplier was credited at that time and purchases account was debited. Now this is called reversing of the entry, right? Now we will reverse the entry. Now the supplier account will be debited in case of purchase returns, and purchase returns account will be credited. See, supplier account debited to purchase return or return outward account, being goods returned to the party. Date here, amount to be debited here, amount to be credited in next line here. This LF means ledger folio. See, every ledger, these are the ledger accounts. This supplier, this purchase, return, purchase, capital, all are these ledger accounts. These have separate ledger folio numbers, and the accountants have the duty to write these respective ledger folio numbers along with this. So if you see, in every account we have this, every journal entry we have this ledger folio, right? Now we have sales return or return inward. See, return inward means whatever is coming to the company. So this is how you can recall what is return inward or return outward. Return outward means going back to the supplier. Return inward means coming back to the company. If I'm selling something to my customers and customer B says, my lot is not good and I want to return this thing to your company, so that is return inward account. So whenever we were having sales account, sales transaction, it was like debtors account debited to sales. Now this entry will be reversed. Sales account to sales return or return inward account debited to debtors account, right? Sales return or return inward account debited to party's name. Party's name is the debtor. Why I'm saying debtor? Because if we would have sold the goods on credit, if it was sold on cash, then also we will write the party's name only here, right? Stock account. The leftover unsold goods at the end of the financial year is represented through stock, right? So obviously whatever goods are being produced, whatever finished goods we have to be sold in this financial year, it's not 100% not that we will be able to sell all of them, right? So we will be having a certain closing stock which have closing entries. So recording of closing stock is related to closing entries. The leftover unsold goods at the end of financial year is represented through stock. Closing stock is the valuation of goods left over at the end of a financial year, and opening stock is the valuation of goods at the enterprise that has at the beginning of financial year. So whatever valuation we are doing at the end of the year of the unsold goods, that is closing stock. That closing stock entry will be only on 31st March 2025 for the current financial year, right? And that closing stock will become opening stock on the next day itself, that is 1st April 2025. So closing stock, obviously closing stock, whenever we are valuing stock, it is like increasing the asset. So increase of asset means debit. So 31st March 2025, closing stock account debited to trading account, being closing stocks transferred to trading account. Cash account. Now there are certain transactions it's just like repeating of purchase and sale transactions given, but there are other transactions also involved in cash. It's the ledger we are discussing, cash account ledger. Cash transactions, only those transactions which are done in cash, they are recorded, whether the payments are being made, whether they are being received at the time of purchase or sale of goods. Cash transactions can be identified when the name of the party and cash both are given in the transaction, when only cash is given in the transaction, when the name of the party and cash both are not given, right? So we are saying if in a journal entry it says goods being sold on cash, we can record, though there is absence of the name of the party, right? Even if the name of the party is not being mentioned, we can record that transaction. How? Goods being sold on cash, cash account to sales, cash being received, asset being increased, and when asset increases, it is being debited, right? Now, when the party name is also mentioned, it is the additional benefit. Goods being sold on cash to ABC company. Okay, but the entry will not change because the sales are being done on cash. When nothing is mentioned, but it's like goods being sold and cash is received, whatever, then also it will be same entry, cash account debited to sales account. And this is for the purchasing. But what are the other entries we can think of? Like rent is being paid. So rent is an expense. When expense is being increased, it is debited. When cash is being decreased, asset is being decreased, it is credited. So rent account debited to cash. So make a simple rule. Whenever is cash going out, it is to cash. It is being credited, right? And whenever is cash coming in, whether it is form of income, sales, whatever, rent being received, so it will be cash account debited to rent account, right? So whenever cash is coming, cash account debited. Whenever cash is going, it is to cash. This is the simple rule of cash account. Credit transactions. Credit transactions are those which are not being done on cash. It is done on credit. When payment is not made or when payment is not received, right? Either at the time of purchase, payment is not made, either at the time of sale, payment is not received. We relate it to as credit transactions. Now, what are credit transactions? We need to have the name of the credit transactions can be identified only when the name of the party is given. How we will record? Agar party ka name hi nahi hoga, how we can do the recording of those journal entries, those financial transactions? For example, I am selling goods on credit to ABC company. So it will be ABC company account debited to sales. I am purchasing from XYZ company. So purchases account debited to XYZ company. I'm again repeating, purchases account is being debited because it's a direct expense. Expense being increased, it is debited. Sales account, sales is a direct income. So when income increases, it will be credited. Now, we have assets account. Assets account are like machinery, building, land. These are fixed assets, right? We have current assets like cash, stock. So basically, machinery, building, land, those assets which have heavy investments, right, which cannot be easily sold. These are long-term assets, right? These are fixed assets. And we also have assets as current assets that can be easily converted into cash, like stock and cash. Now, assets can also be purchased or sold in cash or on credit. It is not represented through purchases, but with the name of the asset, right? Whenever I'm purchasing asset, whenever I'm selling asset, it is not purchases, it is not sales. We mean to say that. Asset is being purchased, it is recognized with the name of asset account. Asset being sold, it is recognized with the name of asset account, not with the sales account. So when assets are purchased, asset account, whatever asset being purchased, for example, machinery is purchased. So machinery account debited. Why? Because machinery is increased. Asset is increased. Whenever asset increases, follow the debit rule. We will debit when asset is increased. Now, if it is purchased in cash, to cash account, cash is being going out. When it is purchased on credit, to party's name account, right? So assets purchased in cash or on credit, right? This will be the entry like this. Assets sold, cash is being coming in, right? When assets are being sold, or if it is sold on credit, that payment on asset being sold on credit means the payment will be received after some time, not immediately. So for that time being, till the time we receive the payment, what we will do, we will record the party's name. Party's name debited to asset account. Asset is being decreased, so it will be credited, right? Then we have depreciation account, right? We know all the fixed assets have wear and tear. They need to be depreciated over the time so that true value of theirs can be recorded. So depreciation is decrease in the value of assets due to use or normal wear and tear, right? Depreciation is an expense being debited to asset account, right? Assets are being decreased, the value is being decreased, so they will be credited. Then discount allowed and discount received. See, discount allowed is when I am selling, we are allowing the discount to the customers. We are giving certain discounts when we are selling them. Discount received when I'm purchasing from the suppliers. I'm getting certain discounts. So a discount is a concession in the selling price of a product offered by a seller to its customers according to it's a concession in the selling price of a product offered by a seller to its customers. So it's a general term we are saying. A discount is a concession by a seller to the customer, right? According to nature, there are two types of discount allowed and discount received. Discount allowed when I am being seller. Discount received when I am being purchaser. So discount allowed when at the time of sales or receiving cash, any concession is given to the customers. It is called discount allowed. So when I'm selling goods on cash, right, and I'm giving discount to my customers, so cash account debited for the actual amount of cash being received. Discount I'm giving to them debited because discount is basically my indirect expense that I'm incurring, right? I'm giving discount, so it's my expense basically. It's reducing my sales value. To sales account, sales is my direct income, so it's increasing. It has to be credited, or if it's being done on credit, to parties' name, right? Being cash received and discount allowed. Now for discount received, purchases account debited, parties name account debited, to cash account, to discount account. When I'm making purchases from my supplier, if I'm doing it on cash, right, I have to pay cash. Cash is being decreased, so it is credited. Discount is my indirect income when I'm purchasing the goods on. When I'm purchasing my raw materials and I'm getting discount, it is my indirect income. So it is again being credited to cash, to discount account, right? Purchases account being debited, it is my direct expense. Expense increases, it will be debited, or party's name. When this party's name comes, when I'm purchasing it on credit and still I'm getting the discount. Okay, that's all for today. We will continue with the tally thing in the next session.